So you can mute yourself and we start. Okay. So let us start. Once again, it is a pleasure having you and seeing you once again. It has been a while. You can wave for me. Just wave at me. Thank you. So I want to hope you can see the words. We starting very quickly in a minute, and we are starting with property income. So if you recall, we discussed last time that gross income is made up of three categories, that is property income, business income, and employment income. That is from section 20 of the Income Tax Act. And then we went further to define property income to refer to any income which is not business income, employment income, or exempt income derived by a person. So for purposes of tax, gross income is under three categories, which is property income, business income, and employment income. Now, when you are defining property income or when you are looking at property income, it is any income which is not business income or employment income or exempt income. We looked at exempt income sometime together. I believe you are familiar now with it. So what are some of the incomes categorized under property income? Under property income, we have dividends, interest, annuity, natural resource payments, rents, royalties, and any other payment derived by a person from the provision, use, or exploitation of property. Now, the value of any gifts derived by a person in connection with the provision, use, or exploitation of property from part of property income. So if there is any gift which a person derives in connection with the provision, use, or exploitation of a property, then that will form part of property income. The total amount of any contributions made to a retirement fund during a year of income by a tax-exempt employer. A tax-exempt employer who makes contributions to a retirement fund, the total contributions are deemed to be property income. Next is any other income derived by a person, including winnings derived from sports betting and pool betting, but does not include any amount which is business, employment, or exempt income. So if there is any income which is derived by a person, including winnings derived from sports betting or pool betting, but does not include any amount which is business, employment, or exempt income. So if we have any incomes a person receives in connection to sports, and let's say that income is under the category of exempt income, then it will not be referred to as property income. An example is when the sports people get their proceeds, like the current Olympics, when those sports persons get their winnings, their proceeds from sports, that income is exempt from tax. So the fact that their income is exempt from tax, it will not be categorized under property income. It will retain its character as exempt income. Okay, so property income is taxed in most cases through a methodology of withholding. Withholding tax, it is another tax head on income. We
Hold
have,
on, can you scroll? Hold on. You're reading, but you had not scrolled up. It's okay. Now I can see. Thank you.
okay. So I was saying, uh, moving away from the categories of property income, we look at how property income is then taxed. And I was saying that one of the means by which property income is taxed is through a withholding. Now, withholding tax is still under the regime of the Income Tax Act, and then it is also administered by URA. There are various categories of withholding taxes, as we are going to see here below. The first form of withholding tax, we have a relationship of employer and employee. An employer is going to pay an employee salary, but the salary the employee receives will be net of pay as you earn. So in effect, the employer has withheld tax from the employee's salary. So the pay as you earn, which is deducted from the employer, from the employee's salary by the employer, is also referred to as withholding. But then that withholding is final. David, you are welcome.
Thank you, sir.
Yes, we have just started.
Yeah,
We are looking at
great.
property income. We have seen the various
Yes.
categories of property income, and now we are looking at how property income is taxed.
Okay.
So the first category here, employment income, is not property income, but I brought it here just to illustrate as one of the forms of withholding by the employer. So the pay as you earn would be a final tax. Shortly, I will illustrate what a final tax means, but in effect, I refer to the tax deducted from that income is final. It will not be permitted as a credit during any further tax liability. Next, we have a resident company. Now, when a resident company is paying an individual shareholder dividends, that company is required to withhold tax on the dividends. Recall from above, we said dividends is part of property income. Now, if dividend is part of property income, we are saying that the dividends will be taxed at 15% on gross payment, and that tax is final. The next is a listed resident company as a withholding agent still, where the listed resident company is paying dividends to an individual shareholder. This listed resident company will withhold tax at 10% of the gross payment, and the tax so withheld is a final tax. We have a resident company paying dividends to a non-resident person. Still, this person will have to withhold tax at a rate of 15% of gross payment, and they will withhold tax with a final withholding tax, WHT. Then we have a resident company paying dividends to an exempt organization or a resident retirement fund. Still, this person will withhold tax at 15% of gross payment, and the tax so withheld is a final tax. Then we have a resident financial institution paying interest to a resident retirement fund or an exempt organization. Still, this institution will withhold tax at 15% of gross payment, and the so withheld tax would be final. We have a resident person or a branch of a non-resident person still paying interest, including interest on treasury bills or other government securities. So if you are paying to a non-resident person, the rate is 15% of the gross payment, and still the withholding tax is final. Jessica, you're welcome. Okay, then we have Bank of Uganda. If you invest in the Bank of Uganda, you buy treasury bills and bonds, the treasury papers. If you have heard of government securities, those are the short-term investments several institutions do invest. If Bank of Uganda is paying interest on the treasury bills or other related government securities, whose maturity period is less than 10 years, then the withholding tax would be at a rate of 20% of the gross payment, and that tax is final WHT. Suppose the treasury bills of all those related securities are for a period of 10 years and above, then in this case the withholding tax would be 10% of gross payment, and the WHT in this case would be final still. What if you have a resident person or a branch of a non-resident person paying what we call natural resource payment to another non-resident person? The tax there would be 15% of gross payment, and the tax would be final withholding tax. Natural resource payments, this is it's a payment from the natural resources, as the word sounds. Is it from the oil fields? Is it from minerals as a result of a mining asset or extraction asset? So if you are receiving payment as a result of the natural resources, then the withholding agent will withhold tax at 15% of the gross payment, and the tax so withheld is a final. What if we may also have a resident person or a branch of a non-resident person who is paying royalties to another non-resident person, and the tax is 15% of gross payment? That tax is also final. Then we have management charge. The WHT is also 15% of gross payment and is final. Then we have annuities. The WHT is also 15% of gross payment and is final. Okay, we have transportation charge for passengers and goods embarked in Uganda. This is a payment by a resident person or a branch of a non-resident person to a non-resident air transport operator or ship operator or charter or through road transport. It is 2% and it's also final. We have mining and licensees. They also withhold tax at 10% of gross payment and it's final. Then URA customs. At URA customs, when you import goods, there are certain goods which are subjected to withholding tax, and the rate is 6% of the customs value. When we are looking at customs, which I will show you how to compute the customs value. So this 6% is not final, it is creditable. By it being creditable, it means the importer can be able to claim the tax paid later on in a subsequent tax liability. Then there are those designated withholding tax agents for payment of goods and services to resident suppliers. This one, I want to think you all are aware if you are working in those government institutions or even private settings. When you supply, the payment is subjected to 6% as withholding tax, unless the supplier is on the list of exempt companies or exempt institutions. The 6% of gross payment is also not final, it is creditable. That is, it will be recoverable in the future tax liability of that taxable person. Professional fees, okay, when you're having consultancy and you pay that resident person, you are also required to withhold 6% of the gross payment, and the withholding tax is not final, it is creditable. We have a resident company paying dividends to resident shareholders. Then in this case, when a resident company is paying dividends to resident shareholders, resident shareholder company, which has less than 25% shareholding, then the WHT there is 15% of the gross payment and is creditable. So David, if you had gone through the other section I had sent you to go through, section 74, you'd have come across taxation of companies and specifically dividend stripping arrangement. Yes. So in the dividend stripping arrangement, usually companies go and buy shares in another company in an attempt to raise their shareholding to beyond 25%, such that the dividends they receive are exempt from tax. Now, that is a form of tax avoidance. It is an aggressive tax avoidance practice, definitely, which the commissioner has the power to recharacterize and then reclassify that income and consequently tax it. So in this case, we are saying if it is less than 25% shareholding, then the 15% applies and the withholding tax is creditable. You have a resident person other than an individual paying interest to another resident person other than an associated company, financial institution, or exempt organization. The rate is 15% and it is creditable. Then we have winnings of betting or gaming. The rate is still is 15% and it's creditable. Then we have reinsurance premiums. If you have a resident insurance company paying reinsurance premiums. Now, reinsurance refers to sharing of the insurance risk. To reinsure is to share the risk or to cede. If you have heard of cessations. So an insurance company, when it takes on a client, it cannot accommodate the risk alone. Because imagine you are insuring Mapera house. So if Mapera house caught fire and it went on the floor, then the insurance company may collapse as well, given that it may not be able to compensate the building. So the arrangement of insurance is such that when you have taken on a risk, you have to cede. It is a requirement. Now, when you cede or when you share that risk, there are those companies which are specifically responsible for just sharing risks. They are not insurance companies, but then they are reinsurance companies. So those companies will pay premium or income to insurance companies. So when the resident insurance company in Uganda pays a reinsurance premium to another non-resident person, then that person is supposed to withhold tax at 10%, and the withheld tax is final. So there are exceptions. There are some reinsurance companies where you're not going to withhold tax when you're paying the reinsurance premium. Examples are those companies in Uganda. That is Uganda Reinsurance Company. We have a PTA Reinsurance Company, and there was the third one, which I will let you know shortly. We have those participation dividends where companies involved in mining or petroleum are going to be receiving. They are subject to 15% and it is final. Then we have uh, payment for an asset. If a resident person or a branch of a non-resident person pays for an asset to a non-resident person without a branch, the rate is 10% of the gross payment and it is final. Now, what if the asset or the business is undergoing a resident to resident transaction? In this case, the rate is 6% and it is creditable, meaning it can be claimed. Telecom companies. Now, telecom companies, they usually pay commission to airtime dealers and mobile money dealers. Now, the commission received by those guys is subjected to withholding tax at 10% and it is final. Also, commission paid by insurance companies and advertising agents. Commission paid by insurance companies to insurance agents, but also paid to commission is received by advertising agents is also subjected to withholding tax at 10%. Okay, that is we have the final one, public entertainers. These ones, the public entertainers, for instance, they have come from West Africa. If you know any musicians who come from abroad, me, I only know one whom I heard about one time. They were called D Square. So those people, when they do performance here, they are supposed to pay. They are supposed to pay tax before they go back, 15%. So they are given a 5 days, and that tax, when it is paid, it is final. So it is either 5 days after completing or the time they are leaving Uganda, whichever is earlier. Now, payment of the tax withheld. Now, the withholding agent who has withheld the tax is required to pay that tax to URA within 15 days after the end of that month. This is applicable in a withholding tax return. It is a special tax return, one of the income tax returns. Like I said, the withholding tax is tax the government is receiving in advance. The government cannot wait for the businesses until the end of the year because they need money to run their activities. So this was imposed to get money early enough by the government. Now, when you fail to withhold tax, you are liable, you are personally liable to pay to the commissioner the amount of the tax which has not been withheld, but then you are entitled to recover that money from the payee. Now, if you recall, I was saying that the withholding tax on payment of interest by Bank of Uganda is final, and I told you that I'm going to tell you the implications of final. So if the tax is final, where that tax has been withheld on a payment of interest, maybe treasury bills and other government securities by Bank of Uganda, to any person or a financial institution or to a resident individual, other than in the capacity of a trustee, resident retirement fund, or to an exempt organization, or the tax has been withheld on payment of dividends to a resident individual, commission paid to telecom service providers on the distribution of airtime and mobile money, that tax is final, like I said. Then what are those implications? One, there would be no further tax liability imposed upon the taxpayer in respect of the income to which the tax relates. So that's why the guys who deal in mobile money, the commission they receive on their phones, they just go and start spending. They are not required to make any returns. They are not required to even pay. They have already taxed. They have already been taxed, and we are saying that tax is final. Two, that income is not aggregated with the other income of the taxpayer for purposes of ascertaining chargeable income. Now, for businesses which invest in government securities, they are not required to combine the income, the interest income from those government securities together with the normal business income. Three, no deduction is allowed for any expenditure or losses incurred in deriving the income. So because we are saying that we shouldn't include the income, then even the expense is not allowed. So in the exam, you may have expenses on deriving income from government securities that will be added back. Then you may have income from government securities or interest that would be deducted or subtracted. But in effect, we are not recognizing it as income tax for purposes of ascertaining chargeable income. And there would be no refund of tax. Okay? No refund of tax shall be made in respect of that income. So, any question? Any question or comment? Hello? Can you hear? Sarah, Jessica, can you hear? It's unfortunate. Jessica's internet network is low. David, any
Yes,
question?
sir. So far, so good. So far, so
Yes, I
good.
can hear you, but I'm on and off.
Do you have any questions so far? Jessica? Margaret? Maggie? Maggie, you are muted. I don't know whether you are speaking. Okay. If there is no question, then let's proceed to another section of provisional tax. Having understood withholding tax, there is also what we call provisional tax. Withholding tax is paid in advance. Provisional tax is also paid in advance. What happens is that the taxpayer is required to estimate the income is going to receive in the year, the whole year. So after the 6th month, before the last date or on the last date of the 6th month from the start of the financial year, the taxpayer is required to make a provisional estimate and pay 50% of the provisional income to URA. So you estimate the income you expect to receive in a year, and pay 50% to URA. So we are saying that a provisional taxpayer other than an individual is liable to pay 2 installments of provisional tax on or before the last day of the 6th and 12th months of the year of income in respect of the taxpayer's liability for income tax for that year. The amount of each installment of provisional tax for a year of income would be calculated as 50% times A, then minus B. Now A is the estimated tax payable by the provisional taxpayer for the year of income. And then B is any credits, any amount of any tax which has been withheld prior to the due date for payment of the installment from any amounts derived by the taxpayer during the year of income, which would be included in the gross income of the taxpayer for that year. So, like I said, the taxpayer will estimate the annual income, then we also estimate the tax payable on the income, and the 50% of the tax payable is then paid to URA. That is done on the 6th month or before the 6th month. This is the due date for payment of the first installment. For the case of an individual,
Oh God.
is required to pay in 4 installments. So that is 25% times the tax payable. Now, B again is any withholding tax which has been subjected to the individual's income. Okay. Now, basically, that is provisional tax. If you do not make a proper estimate of the provisional tax, the URA or the law, the income tax, provides for penalties. And one of the penalties, or the key penalties, where a provisional taxpayer has made an estimate or revised the estimate of chargeable income for the year of income, and it is less than 90% of the taxpayer's actual chargeable income assessed for that year, then the penalty would be 20% of the difference between the tax calculated in respect of the estimate as revised and the tax calculated in respect of 90% of the taxpayer's actual chargeable income. This one is a common area. I implore you to interest yourself in it. It usually takes 4 marks, 3 marks. If you check that number which you did, was it December 2020? David, which year was that? David is out.
It was December 2020.
December 2020.
Can you hear me?
Yes, I can hear you.
Yes.
Okay, Roman 2.
You had gone off.
Roman 2, you saw that? Roman 2 was advise the company on any penalties payable, if any.
Yes.
Okay. And then if you check, yes.
Yeah. Kindly put off your video. I can't see the other board.
Oh, you can't see what? Yes?
The notes.
No, I had removed.
Yeah, okay.
I had removed.
Mm.
I was showing you that question.
Yeah.
December 2020.
Yes.
Can you see that? Please confirm.
Yes, I can see it clearly now.
You can see it clearly.
Yes.
So we are looking at note 10. Note 10. You can see note 10.
Yes.
Note 10. Note 10 is saying the provisional tax paid for the year ended 30th June 2019 was 500 million. Paid on 31st December 2018. Okay? The tax computed for the year ended 30th June 2018 was 1,378,294,000, which had all been paid by the due dates. The tax return for the year ended 30th June 2019 was filed on 30th April 2020, the date on which the tax due was also paid. The company had not obtained approval for extension to file the return for the period. So I have not informed you about also the filing dates, but this is already the date. Supposed to be by the 6th month after the year end. Now, when you look at June 2019, if the year ended 30th June 2019, then it was supposed to be filed by 31st December 20. Wait, if the provision is for the period ending 30th, it was what? 31st December 2018. Okay. Then the final should have been by 30th what? June. So there is a penalty here for late filing, and there is also a penalty here. If you check those figures, you will notice that there was also a penalty for under provisioning. So you will make time and go through it. You compute those penalties and share with me. Okay. Is everybody on track, or I'm talking to myself?
We are there. I'm there.
David, I can hear you.
I'm also there. I'm there.
Okay. That is good. So you will go and compare the 90% of the final tax with what they paid, the 500. Then the difference, you will charge it 20%. So how many months is the federal rate? Should have been 31st December 2019, but the guy is filing them in April. So those are 4 months, not so. So the fellow is 4 months late. So penalty for late filing is 2%. 2% of the tax payable, or 200,000 per month, whichever is higher. Hello?
Yes, I'm on.
Okay. So we proceed. For Maggie and Jessica, they have seen this before. So David, you will go attempt it and share with me on WhatsApp.
Okay,
That very Roman too.
fine.
Yes. So let's go to rental income. Now, rental income is a very interesting area. It is one of the area which has got a significant amendment this year. But once the exam is this year, then the amendment will not apply. I'm just going to inform you about the amendment such that if the exam is extended to maybe March, then you may have to apply the knowledge. However, you need to retain your old knowledge as well as the new knowledge. That is the unfortunate bit, but you need to have both. So in the exam, you'll pay attention to the years which the examiner has gotten interested in. If for those who have seen it before, for David you have not, but then we said rental income, our emphasis last time was like rental income is taxed separately. What is rental income? Rental income is the total amount of rent derived by a person from the lease of immovable property in Uganda. So if the property is outside Uganda, then that rent will be part of property income. And we have seen how to deal with property income from above. Rent is a payment usually made as a consideration for use or occupying a property, land, or buildings. Now, the rental income a person earns is subject to income tax, irrespective of whether the property was acquired through inheritance, a loan, a mortgage, savings, donation, etc. So in other words, it does not matter how you got that property. As long as you are getting rent from it, you are required to pay rental tax. Okay? Rental tax, since that income is defined as rental income. Emphasis is rental income of any person is separated from other incomes and taxed. Okay? So never combine rental income of a person with other income of that person. That will be wrong. So whenever you have rental income, you tax it separately. Okay. So you are required to file the rental tax returns to URA, whether the property is making profits or not. The minister sometimes is given powers to issue an instrument regarding the property rates, depending on the location of your property. That is for rental prices. So the rental income of property located in Uganda is taxable in Uganda, irrespective of whether that person who receives the income or owns the property resides. So it does not matter whether the person stays in Uganda or the person stays outside Uganda. As long as the property is in Uganda, it is subjected to rental tax. So rental income tax is section 5 of the Income Tax Act, if you want to read more. Now, a person who in the old law, which is still applying for purposes of exams, a person who is allowed deductions of expenditures or losses in connection to rental income, and the rental income of a company is taxed at 30%. That is rental income minus rental expenses, taxed at 30%. That is in the old law, which is applying for purposes of the exam. But the new law is requiring that whether a company or an individual, the expenses are subjected to a rate of 75% of rental income. So whether it is a company or an individual, they are given an allowance of 75% of rental income as expenses. Now, for an individual, still the new rate is 30%. The old rate has been 20%. And still recall that for your exam, might require you to answer in the old, using the old rates depending on the year the question has been structured. So the rate is 20%, but the revised rental income of an individual is subjected to tax at a rate of 30%. The old law requires 20%, and still in the old law, the expenses is not 75% of rental income. For an individual, it has been 20% of rental income, and also the threshold plus any interest on mortgage. But in the new law, the threshold is not applying. Instead, they are only looking at 75% of rental income as being the expenses of an individual. So what has changed here is a lot for rental income. The rate of an individual has been increased from 20% to 30%. The allowable expenses have been increased from 20% to 75% of rental income. But in the new law, it has been 20%. And the rate of tax, rental tax, has been 20%. So if the exam is in October, most likely they may be testing on the old law. So we wait how the examiner will structure it, but you need to be aware of all methodologies. If he asks you about the amendments, you also need to be alert. Suppose he brings a theory question, it may not be a calculation. He may want to test you whether you are aware of the amendments. And maybe he requires you to comment or write brief notes or something like that. So you should go with both sides. Are we together? Hello?
Hello.
Are we following?
Yes.
Yes.
Okay. So like I said, if the rent is derived by a non-resident person from leasing the immovable property in Uganda, then that will be subjected to 15% withholding tax as final. In this case, that rent is property income for a non-resident person. Okay. For a resident person, we said rental income is taxed separately. That is, it is segregated from that person's income and then taxed separately. If it is an individual, in the old law, you would use 20%, and then the rental expenses would be 20% of rental income. In the new law, it is now 75% of rental income. The threshold no longer applies. The threshold, I mean the 235,000 per month or the 2,820,000 per year, has been scrapped off. So you are looking at only the threshold. I mean the ratio, the 75% capping on rental income as the rental expenses. But like I said, do not abandon the old information since the exam is soon, and chances are that the examiner may have used the old law in the exam. If the exam is extended, then you need to appreciate the revised knowledge. The examiner may test you on the new law. Still, the examiner might test you whether you are aware of these amendments and subject you to a theory question, whether you can be able to explain some of these amendments, or he might ask you the implications. So I interest you to familiarize the amendments. Any question on rental income? Because we are going to VAT, we are going to end with the VAT. Any question on rental income? Hello. Any question on rental income?
Yeah, I'm good. No question.
David,
So far, so good.
you appreciate the two sets of laws, both methodology, the old law and the new law.
Yes.
So when you are reading the equation, you remain alert. What is the interest of the examiner? By the way, I also forgot to tell you that in this exam, you need to understand the intentions of the examiner, and then the examiner also needs to understand your intentions. So when the two reconcile, then you have passed. So you as a student, you need to work hard to understand the examiner's objectives. What is his interest? Usually examiners do not want to be uh, to be what? To be predicted. But then you as a student, that should be your target anyway. You need to know what the examiner has put in the script. So you go with both ammunitions. You have your arrow, your spear, and the AK-47. If he uses a spear, you use a spear. If it is fire, you use also fire. So you be prepared in that respect, so that it does not challenge you in any way, whether theory or calculation. Is that okay?
Yeah.
Okay. So if Jessica, you have been off and on, do you have any question on rental income? Tax on rental income? Jessica, you are muted. I don't know whether she's hearing us. Well, we can proceed. In case of any, we shall respond to it. So, value added tax, VAT. VAT is a common area for the examiner. It is always there, you cannot miss it. And after this session, I'm going to encourage you to go and attempt all the VAT questions from December 2016 to March 2021. Are we together, David?
Yes, sir.
You look out for all the questions on VAT from December 2016 to March 2021. Why I'm saying December is that before December, the syllabus was old. The current syllabus is updated, so the questions which might be applicable, you need to look at the recent papers to achieve what you want. So in my preparation, I did it cognizant that you have studied paper 6, but if you didn't study paper 6, then you are exempted from paper 6, the fact that you have had tax knowledge before. So I have skipped the registration requirements for a person to be registered for VAT, that is under paper 6. So it will not be examined in this paper, but also you are required to have that knowledge. We can discuss it sometime to come, maybe during revision, but it is not mandatory. I have highlighted what is key for purposes of your exam. So VAT as in an indirect tax, it is administered in stages through the production system and distribution to the final consumer. Now, the final consumer usually bears the burden of the VAT. The system of VAT is such that the intermediaries are allowed to recover any VAT paid from their subsequent returns. Okay. If I can show you, I don't know whether you can see that chart. They look so small, but I'll find a way of expanding them. Can you see that?
Yeah.
Yeah. Okay. Basically, what I am illustrating here is that VAT is charged on supplies, and these supplies are supposed to be taxable supplies. So we are going to have taxable supplies which are categorized into two, which is standard rated supplies and zero rated supplies. Now, standard rated supplies are not listed anywhere, but zero rated supplies are listed in the third schedule of the VAT Act. Then the exempt supplies are listed in the second schedule of the VAT Act. David, I don't know whether you have schedules for those items of VAT, those which are exempt and zero rated.
Have them on my act. Have them on my act.
What about in your notes for CPA?
I don't think I have them. No, I don't have them.
They should be there. They should be somewhere. Because your act may be old. So your act needs to be updated. You never know. Yeah. So the VAT charged on sales is referred to as output tax, and the VAT charged on purchases is referred to as input tax. Now what happens is that at the end of a period, which is 1 month, the taxpayer will get the total output tax minus the total input tax, and if he gets a positive, then you'll pay that to URI. If it's a negative, then that will be claimable from URI. Okay. Now, the VAT still is applicable on a taxable value, which is a value of a taxable supply and is the total consideration paid in money or in kind by all persons for the supply. Now the rates applicable or the rate applicable for VAT is 18%. However, for the purposes of computation, whenever the examiner has stated that the items provided are exclusive of tax, or if you have invoices which are exclusive of tax, the rate applicable would be 18%. That means that particular transaction does not include VAT, and therefore you use 18% times that value. Suppose the examiner says that the items provided are inclusive of tax or inclusive of VAT. Whenever the examiner talks about inclusive, you should mark those words. Then the rate applicable is 18 over 118. For inclusive, it is 18 over 118. Inclusive of VAT, 18 over 118. Then exclusive is simply 18%. Zero rated supplies, definitely that is 0%. And standard rated supplies, definitely that is 18%. So those ones are not included in either the second or third schedule, which I was telling you of the VAT Act. So whatever does not follow in the zero rated supplies and exempt supplies automatically becomes exempt supplies, unless it is outside the scope of VAT. Okay, so for exempt supplies, VAT is not applicable. Now, for taxable supplies, I mean both zero-rated supplies and standard-rated supplies. Okay, standard-rated supplies, those are supplies whose VAT rate is 18%. And zero-rated supplies, those are taxable supplies whose VAT rate is 0%. Now, one may ask that what is the difference? The supply which is zero-rated, this person is not going to pay VAT on that supply, output on that supply. However, if this person dealing in zero-rated supplies incurs expenditure on acquiring assets or paying for expenses in making zero-rated supplies, then this person has chance to claim credit of the VAT incurred on the zero-rated supplies. So the expenses incurred in bringing into use zero-rated supplies is subjected to is claimable from URA. So that's the benefit of having zero-rated supplies. Okay, input tax credit. Now, input tax credit refers to the VAT which is incurred by a VAT registered person on account of supplies used or intended for use in the person's business. So in other words, if a person acquires supplies which are not used in the business, then that input VAT will not be credited or it will not be claimable. So for a person to claim VAT, that VAT should have been incurred in the supplies which are used in the person's business. And the claim for input VAT on imports or domestic purchases is only for taxable persons who are making taxable supplies. So if you are not a taxable person and you're not making taxable supplies, you don't qualify for the input tax credit for VAT. What are the conditions? What are the conditions for input tax credit? The first condition here is that the taxpayer must be a taxable person registered for VAT and must provide you with an electronic invoice or an electronic receipt. This was an amendment in 2020. It was effective 1st July 2020, although in the effectiveness, applicability in the field, it started 1st January 2021. There was an extension due to lockdown challenges, so the implementation was extended to January 2021 this year. At the moment as I talk, which is in operation, for you to claim input tax credit, you need to have what we call a fiscalized invoice. A fiscalized invoice is an electronic invoice. Usually it has a fiscal document number and a verification code. So what is key here is the invoice to have a fiscal document number. Now this invoice is generated from URA portal if you do not have a system. If the system of the taxable person is not integrated with the system of URA, then URA has given an opportunity to produce the invoice on your behalf. But if your system is integrated, then your system can be able to produce a fiscalized invoice, which can be used to what? To in payment of VAT, and also provided to your customers to enable them claim VAT credit. This invoice is very key because without it, and this transaction will not be allowable for income tax purposes, and it is also not allowable for VAT credit purposes. So when you are computing business income tax, if you come across a transaction which the business entered into and did not have an electronic invoice, if that query is highlighted in the exam, then that transaction is not allowable. You would add it back on account that the transaction lacks a fiscalized invoice. The second condition for input tax credit is that for newly registered person, the credit is available for them for the goods they have on hand, provided they were in existence within 6 months before getting registered. But for the case of manufacturers, they are given a chance to go up to 12 months. Now, the new amendment this year, which is applying in 2021 onwards, is that a taxable person shall apply for input tax credit within 6 months from the date of the invoice. Now, in the old law, there was no limit. There was no limit on when the person should stop claiming input tax credit. Now it is clearly highlighted that you can only claim the input tax credit on an invoice within 6 months after the date of the invoice. The other is that the goods or services giving rise to input tax must have been acquired for the purpose of the claimant's business. This one I've already emphasized that for a business to claim for input tax credit, the expense should be directly related to the person's business. If it is a private expenditure, then that expense shall not qualify for input tax credit for VAT. Now, there are some taxable supplies which are specifically excluded from input tax credit. This is highlighted in section 28 of the VAT Act. The first one, we are saying that no input tax credit is allowed in respect of a taxable supply or import of a passenger automobile, including their repair, maintenance, and spare parts, unless the person is in the business of dealing in or hiring of such automobiles. So, and if it is a road vehicle, that car will not qualify for VAT. So what is excluded here is maybe a commercial vehicle. But for a passenger automobile, it will not be allowed for VAT input tax credit purposes, unless that person is purchasing that or incurring that expenditure as a way of completing the ordinary business transaction. If the person's normal business is to sell cars or is a garage as such, that means you are in the business of repairing cars. You are in that case, you can be allowed to claim. But here, if it is not your core business, then the expenditure is not allowable. For purposes of VAT, the input tax credit will not be accepted. We are also saying the second one that no input tax credit is allowed in respect of a taxable supply or import of entertainment unless the taxable person is in the business of providing entertainment or supplies meals or refreshments to his or her employees in premises operated by him or her, or on his or her behalf, solely for the benefit of his or her employees. So entertainment expenditure is also not allowed for purposes of input tax credit. The third transaction is that no input tax credit is allowed in respect of a taxable supply or import of telephone services to the extent of 10% of the input tax on those services, except for call services which are supplied to a hotel, a lodge, or similar establishment where output tax has been accounted for by the establishment on the supply of that service to their customers. So in other words here, what the law is presuming is that the 10% of the input tax of VAT, that expenditure is usually assumed to be for private purposes. You know, when you're in office, the assumption is that when you have been given airtime, it will be very hard for you to say that the airtime given to you, you are only going to call clients. You will not call any parent or any of your friends, your wife, your husband. So it is quite hard. So they assume that there is some private consumption and they put it at 10%. So they say because it is private, then the expense, the VAT attributable to that is not claimable. So the 10% of the VAT would not be claimable. That credit is not accepted because the 10% is taken as a private consumption of the telephone services. Now, there is a scenario where you have a taxable person dealing in both exempt and then taxable supplies. If a taxable person is dealing in only taxable supplies, if a taxable person is dealing in only taxable supplies, that is to say either standard rated or zero rated, then it is easy to get the VAT payable or claimable. It's a matter of getting the output VAT minus the input VAT. When you get a positive, paid to URA. When you get a negative, that is a claimable, an offset claimable from URA. Now, in case you have a mix where you have some exempt sales, then the law provides for apportionment of input tax credit. Now, this apportionment is a principle usually sometimes referred to as a de minimis rule. We are looking at taxable supplies being split. Maybe the person is having a bit of taxable supplies and also exempt supplies. So in this case, the input tax credit is what? Prorated. And the formula is A times B times over C, where A is the total input VAT, that is the credit for the period, and then B is the total of the taxable supplies. Now, like I said, taxable supplies, I mean both zero rated and standard rated. Okay? Then C, A times B over C. C is now the total supplies or the total sales. Okay? So from that formula, that ratio of B over C, you are saying taxable supplies over total sales. So the law provides that if the taxable supplies are less than 5% of all supplies made in a given period, then you don't have to claim for any input tax credit. That means the taxable supply ratio is very low for you to qualify for input tax credit. Of course, apart from the supply of goods or as part of the transfer of a business as a going concern, that one is definitely exempt. That's why we are saying excluding that. Now, the ratio B over C, suppose it exceeds 95%. If it exceeds 95%, it means that the taxable supplies are more by 95%. The ratio of taxable supplies to total supplies. So because you have more taxable supplies, then the law here says that claim all the input tax credit on the taxable supplies. All the input tax credit for the period is claimed. Okay, now suppose the percentage ratio B over C is between 5% and 95%. If it is between 5% and 95%, then it is prorated. Now you may have a taxpayer who may be disadvantaged by that standard method, that method of apportionment. So if he's disadvantaged, then that person can apply to the commissioner to be provided with a standard alternative method. Now, once the standard alternative method is approved and granted to the taxpayer, then the taxpayer will be allowed to claim all the input tax credit, which is directly attributable to the taxable supplies, and claim no input tax credit that is directly attributable to exempt supplies. So if you have expenses which are directly attributable to exempt sales, the VAT on those expenses will not be claimed at all under standard alternative method. Then if you have expenses which are directly attributable to taxable supplies, then the VAT on those expenses would be claimed in totality. Now, the balance would be the expenses which you cannot trace to either taxable supplies or exempt supplies. That means it could be maybe electricity bill in the house. So that one will apply for both. In that case, you will prorate. Then VAT refund. The VAT system is based on a tax collection in a staged process whereby some persons will end up having excess in their excess payments, which will attract a refund. So there is a criteria for VAT refund. One, someone should be first of all making taxable supplies, and then that person must purchase goods or services from a taxable person and also issued with an electronic invoice or receipt or several electronic invoice or receipts. Now, in the new amendment, this one, if you are an individual, you can get up to 5 million if as a refund from your transactions you have incurred in a period of 30 days. You will then qualify for a refund of 5% of the tax paid. So as long as your invoices can total to 5 million, you can qualify for a cash refund up to 5% of the tax paid. So this is a measure by URA to encourage compliance of using e-invoices. So you people who make quite maybe good purchases in a month, here you go, URA is going to be refunding 5%. As long as you do not pay VAT, you are a non-taxable person. So you'll be getting back 5% of the VAT you have paid, provided within the 30 days. Provided within the 30 days you have incurred expenditure worth 5 million. in a month. So you'll get 5% of the VAT you have paid on those items you have acquired. Of course, the general rule before even that is that the input VAT is refundable provided it exceeds by 5 million. It exceeds output VAT by 5 million. Except for exporters. Exporters can claim input VAT of an amount. Now, when goods are lost, when they are lost, you can go and claim for a refund from URA, provided you had paid VAT on those goods which are lost or destroyed, and then you are sure that the goods are not expected to be recovered. Then we have bad debts. If we incurred and you have taken reasonable steps to recover and failed, usually the debt maybe has lasted for 2 years and you have not received any payment in full or in part, then you can also qualify for a refund. We also have diplomats and diplomatic missions. They also apply for refunds because they are not taxable persons. Okay, what are some of the VAT penalties? As a reminder, VAT penalty 1, when you do not register, you pay double the amount of the tax payable, commencing in the period in which you applied the last day of the application period until either you register or the commissioner forcefully registers you. The other penalty is when you fail to lodge a tax return within 15 days following the end of the period, you pay 200,000 or 2% interest charge for the period of the return outstanding, whichever is what is higher. Then, when you fail to pay tax on or before the due date, you're also liable to pay penal tax on the unpaid tax at 2% compounded. And also, when you fail to maintain proper records, the penalty there is double the amount of the tax payable by the person. Then, if you make a false statement or a false declaration to URA, misleading statement, and in your statement or in your declaration, you end up paying less tax, the penalty would be equal to double the amount of the excess of the tax or the refund between the tax properly payable and the tax which was paid. So the difference is doubled, and that's the penalty. Hello? We are ending here for today. If you have any questions, you can put up. Otherwise, we are done. Yes, Jessica, I have finished. If you have any question, you may ask. If it's not there, then we can conclude. I have finished. But this recording is available. If your network was not stable, I'll share, and then you can be able to go through. Jessica, can you hear me? Yes, Maggie, thank you for turning up. We have concluded. The network has been unstable, but I'll share the recording.
All right. Okay. Thanks for taking the time.